Well, hello, everybody, and welcome to today's webcast brought to you by Regiment Securities and Cogent Law. Today, we're covering Liquidity Isn't an Event, Early Strategic Paths for Founders. So it's going to be a real interesting session with myself, Dean Delisle, and I have my co-host with me, Jack Bauman, and we are excited to have this discussion with you. It's the end of a three-part series, and hopefully you have seen the other two parts. So with that being said, I'll just give you a little background on myself. I started Merrill Lynch back in 1982, so now you know how old I am. And so I've been in capital markets and raising capital pretty much my entire career. And now I'm currently the chief revenue officer and a managing partner at Regiment Securities, which I'll tell you about in a few minutes. But I enjoy helping issuers and founders raise capital, prepare to raise capital, and hopefully take them to whatever that exit event looks like, whether it's an M&A transaction, or it could be an IPO, or all the above, as they say. So we really enjoy that part of our job. And with that being said, I'll turn it over to Jack and let him give you a little background of himself.
Well, good afternoon, everyone. I'm Jack Bauman. I'm a partner at Cogent Law Group, which is a DC-based firm. I'm physically located in Fort Lauderdale. Um, uh, Similar to Dean, my pedigree goes back to the mid-'80s, Skadden Arps, New York, where I was an M&A and corporate finance attorney for a number of years. I've also worked in-house as chief legal officer of several New York Stock Exchange traded companies, best known of which are Public Storage and their sister real estate investment trust, PS Business Parks. I've worked on quite a few, both friendly and hostile M&A transactions, financings, and work closely with family offices and private equity firms in connection with their growth, and both private and public placements.
So Regiment is a FINRA registered broker-dealer, and we provide investment banking, capital raise activities. And what's interesting is we have quite a few disciplines. When you look at alternative investments in private markets, we pretty much have folks that are in all departments. Now we're considered more boutique because we only have 35 reps. But of those reps, each rep usually has two or three or four disciplines that they handle. So, for instance, I handle a lot of real estate, I handle a lot of technology, and I handle a lot of sports. I like sports, so I handle sports funds and some of those types of things. So what's interesting is I mentioned before how we deal with the issuers, but we also represent a lot of large investment banks and hedge funds on what they call their cap intro. So um, we what that means is that they have billions of dollars that they deploy and they count on us to find them good deals. So we sort of work both sides of the aisle, and it's like being a matchmaker. We also have a huge retail distribution engine for Reg A's and Reg D 506Cs, where we can raise capital with that platform called Regiment Express and that engine. And then we also are involved in a lot of the IPOs. So some of you saw Medline and Figure and Bullish and Gemini and all those companies. And we're continuously doing IPOs because we have over 50 million brokerage accounts that's part of our network. And so when we become part of a selling group for that IPO, we can push a button and generate a lot of global activity for that IPO that's going off. So we enjoy that. And again, we also have an M&A group. So depending on where our issuers want to exit, merge, acquire, be sold, we can help with those facilities too. And that's somewhat where we work with Cogent as well. So Jack, that'll dovetail into how Cogent supports us and everybody else.
Thanks, Dean. Yes, Cogent is a national law firm. It's based in Washington, D.C. We have attorneys up and down the East Coast and as far west as Northern California. The firm's focus is very broad. I head up the corporate side of the legal practice, and I'm licensed in both New York and Florida. But we also have a very robust fintech practice, working with digital asset token issuers. We have an immigration practice. We have cannabis practices in terms of cannabis banking and as well as related legal work in connection with those, as well as the typical roster of activities that firms engage in. My practice is primarily focused on clients who are raising capital or either buying a business or exiting a business. We represent both purchasers and sellers in those transactions, and also represent companies in connection with capital issuances, common preferred stock, as well as the type of private placements that Dean mentioned, typically Reg D offerings. Um, so that's a little bit of our background.
Yeah, that's great. So before we dig in, I want you to find at the bottom of your screen should be what's called Q&A. This is where you're going to be asking questions. So Jack, as you heard, is sitting in Fort Lauderdale. I'm physically sitting in our Chicago offices, which is our corporate headquarters. Um, and what I'd like you to do is type into the Q&A, where are you checking in from? This will let us know that you can find the Q&A, and this is where you can ask questions throughout today's program. So we have Kansas City checking in, we have other Chicago folks, LA, we have Miami, New York. So continue to check in, and then we'll get a sense that, again, you can find the Q&A section. So Jack, let's dig in and get started. So we think about, liquidity, and a lot of times when I meet issuers and founders, they always think it's like it's achieved at the end of the road. It's like they're not thinking about it early on, and so whenever we see folks, we're like, it's not a finish line. It's a mindset that really you should be continuously looking to figure that out from almost day one or at least the first couple years that you're in business. And I always say go into business with the end in mind because a lot of times we have these grandiose ideas that, oh, I'm going to leave it to my kids, and and which we know works out what, like 8% of the time maybe. So when we think about that, so what comes up for you when you run into a founder or an issuer and then you start to talk about liquidity from the legal side?
Well, many founders, understandably, in the early in the life cycle of their organization, they concentrate on the product, the hiring, the growth of the business. But in parallel, there are structural choices that are being made, simultaneously around financing, governance, and ownership. And many liquidity outcomes, they're effectively set years earlier, before the liquidity event ever occurs, through things like the capital structure and legal design of the enterprise. And we hope to give you some insights from our experience into some of how those things can shape and direct an outcome. Because our thesis here is that optionality on liquidity is it's intentional and you have to plan for it, or your options can disappear.
Yeah, for sure. Um, you know, and so, in terms of a best practice, we think about um, you know, starting obviously as we just discussed um, the timing in terms of it as early as possible. But when we think about, and I was just actually on with a founder before this, and I asked him, I said, "Hey, listen, what are you planning in terms of when when your time to get out of the business?" And he said, "Well, I've got a good 10 years in me." And I said, "Okay, so what happens after that 10 years?" And so it really took some pause because, he wants to go out and talk about raising capital and soliciting investors. And so he hadn't thought about in terms of what he's going to do beyond the business. And I said, is it going to go to your family? Do you see yourself, possibly acquiring other companies or getting acquired or an IPO. And it was just an interesting pause and exercise when we had that. So I'm sort of curious from the audience while Jack and I are talking for your business, and this is for the founders and issuers out there. What is your destination for you or the business as you're thinking about it today before you hear us talk about these things? But so Jack, when you think about this, when do you think the earliest is they should begin to consider this?
Almost from day one. I mean, when you're, with any organization, one of the first things, that gets put in place is what the capital structure of the company is, who the owners are, the investors, and in that context, the capital structure can determine economic priority, governance power, who makes what decision, things like downside protection. And these decisions are really made very early on with your choice of investors, whether you're going to use preferred stock, the terms of those, the board composition, and those become embedded in the company's governance framework.
Yeah, exactly. And it was interesting. I remember I had a company back in the 90s for about, oh man, it was about 7 years old at the time. And then somebody came knocking on my door and they said, "Hey, listen, we want to help you with a business valuation." I'm like, "Well, what do I need that for?" They go, "Well, someday you might want to raise capital or someday you want to consider selling your business." And it was interesting, I was, a younger man and I wasn't thinking about that at all. I was just thinking about how I could achieve, generating more revenue, right? And making more money for myself and the employees and the families that work for us. But when do you see, I always find this interesting, but in terms of a business valuation, I always think like 3 to 5 years in, so at least you know what the business is worth. And that means that you have, it's sort of a check and balance that you have your financials in order, your legal documents in order, contracts are in order, and things like that. What's your thought on when that valuation should take place?
Yeah, I think the view of 3 to 5, years in is a good one, but I think it's also important to keep a sense of, the various people who are going to, become your investors in early seed rounds. Venture capitalists often think in terms of a, 7 to 10 year time horizon, in terms of an investment and, when, and, with a view towards, in the end, a liquidity event. And as a result, I think it's prudent, to, as early as 2 or 3 years in, or certainly prior to the first, Series A capital raise, I think would be the best time to really begin to focus.
Yeah, that's an excellent point. And then, you know, also you want to think before you raise capital or you go for any outside capital and think about these events, you want to make sure that the share structure and the cap table is in a good position, right? So that, you may have distributed shares to employees or people that helped you found the company. And it's interesting to see Jack, I'm sure, is probably getting like this pit in his stomach because how many times he's had to restructure or unwind cap tables. I remember we had raised a few years back about $80 million for a company, and they had all these individual LLCs and they had investors in all the different LLCs, and then they wanted to go public. And I'm like, well, now we gotta roll everybody up. And that roll up exercise was not only painful, it was costly. And they thought about that early on, before we raised $80 million, or maybe even before we raised $10 million. It would have been better to know in the beginning, what that exit or that growth strategy was before we had to go through the rework of everybody's cap table.
Yeah, and Dean, you're absolutely right. I think the structure of the cap table and, talk for a minute about preferred stock, which is often a vehicle that's used, in the different series rounds. Things, how that preferred stock is structured, things like liquidation preferences, participation rights, anti-dilution provisions, all of those play into the capital structure, and they dictate what you can do and when you can do it. There's something called a stacked preference structure, that sometimes you see in these capital raises. I'm happy to give an example of that, but I'll defer to you if you want to talk about that for a minute.
No, jump in because I love this topic. So
Okay. Just to try to keep it simple, I like to use the example of a company that, goes through, let's say initially three rounds, a Series A, a Series B, and a Series C. Let's say the Series A is a 10 million raise, Series B is a 20 million, and a Series C is a 30 million. So you've got what we call a preference stack of 60 million. You add up, those three series of preferred stockholders, to a preference of 60 million, which means they get paid before anyone else in connection with a sale or any kind of liquidity event. So if, for example, in a stack structure like that, if the company sells for 80 million, let's just call it, the investors, they get the first 60. That leaves 20 million for common shareholders, including the founders, employees, and what have you. So, things like how you create that cap table, how you structure it, and the as I mentioned, things like liquidation preferences, participation rights, all of those can really kick in and really hamstring you when it comes to either a larger event, like a public offering or private, or larger private raise.
yeah, and if you guys have questions about this, we see some questions building. We will have a Q&A session at the end and we'll address a lot of those. Something I just thought about is, Jack, sometimes things don't go as planned. So let's
More
say
often than not.
let's say you have an A round, and a B round and a C round, like what you mentioned, and the market changes as it does, right? Without us
Mhm.
realizing it. And we maybe didn't properly prepare for the market to change. And now we have to figure out, we need our own liquidity situation to try to survive, right? We're in survival mode. So what are some things from the legal side that you see that maybe people should have to protect themselves, or clauses they should have in their agreements that would protect the founder and the founding members in a situation like that when there's a downturn?
Sure, sure. I think John Lennon put it well when he said that life is what happens when you're making other plans, and that happens in the corporate world too. But yeah, Dean, to your point, you can build in the legal structuring, of the corporate documents, things like who has control over key decisions. For example, preferred stock typically has very protective provisions giving investors veto rights over major corporate actions, things like sale of the company, issuance of more securities, the next round, changes to the charter, board size. these things allow investors to block transactions, that could, impair their economic position. So if things change and the company has a need to, have a new round sooner than they would have liked, but the people in the Series A or B, are already in and opposing, they can block you. Another important issue that can determine your flexibility is board control and governance. Typically, it starts out very founder friendly and, friends and family people appointed, but as people invest, they'll often ask for a board seat in connection with a Series A or B, and that leverage shifts over time. It changes the dynamics of decision making. So I think companies need to be very attuned to that and trying to keep at least something close to majority control over those decisions. Otherwise, founders, they often underestimate these governance shifts and they can lose out. They lose negotiating power.
Yeah, one thing I've used previously, and I'm sure you've seen a lot of this too, but I always think of I think when I first heard about it was Facebook and Zuckerberg, but they're known as you know, super voting shares, right? So where you
Mhm.
have maybe a Class B share that is for founders and insiders that it maybe have 10 votes per share. And so if you're electing board members and things like that, where then the Class A shares that you're selling to the public, they only get one vote per share. Can you speak to that a little bit and why, that's important to consider?
Yeah, that's a very elegant structure, which if you don't put it in place early,
Right.
chances are, the people who come in or are looking to invest at a later date, there may be some resistance, to putting that structure in place and, issuing those kind of super majority, or rather, I'm sorry, super voting provisions, into the charter. So, I think the founders at Facebook, Meta, Zuckerberg was, clever to have thought of that ahead of time. Many owners don't. And they lose that flexibility, but that is a way to try to manage, and to keep keep at least a semblance of control. I think another area that can come in and these situations is um, things like secondary liquidity and
Oh, yeah.
secondary transactions. They can allow founders or early employees to sell a portion of their shares prior to a full company exit, and those type of things can reduce concentration risk and um, can take some of the pressure off. But um, I may be getting ahead of myself in the conversation.
No, no, no. But I was going to say we talked about concentration risk last week when you have whether you have one client or a big customer that's like 70% of your business, or you have a founder that doesn't have a board or doesn't have other partners in the mix to help make decisions. So that's a weakness because of the level of concentration. We talked about that last week on the M&A. But I think it's important here to note too that when you're doing those assignments or you're selling those shares, it's okay to maintain control, but then also show that you have um, flexibility and you have some diversification within the decision making that's happening. And then also assigning some to board members, right, who are helping to drive the company and make those decisions. That's another factor too.
No, and Dean, your point's well taken. I mean, surrendering a certain amount of control in order to get good people in on your board and elsewhere, it's not inherently negative. Experienced investors, they can provide very valuable guidance and oversight. And, oftentimes, as a company grows, the founders will, retain influence at the board and shareholder level, as will the investors. It's always helpful to have an independent, board member, on a board who can sort of give a less, has less of a personal stake in the matter, but who can provide some adult supervision in the room.
Yeah, exactly. No matter how old you are, sometimes you require adult supervision.
Uh,
Yeah,
but sometimes I think I need it more now than I used to, but
I've been in some very emotional boardrooms, that's for sure, and founders' offices, as I'm sure you have. Um, I was just going to say for fun, it was interesting because I knew that the Ford family had these super shares and they had a very unique structure that I always thought was done right from the get-go. But it was, where Zuckerberg has 10 votes per share, and he still holds a very significant part of the company. Ford Motor family has 16 votes per share. And I've usually seen the common 10, but I was sort of curious because I think I had remembered from something I read early on that Ford was one of the most aggressive for family members and how they hold the company. And I think they control 40% collectively as a family. So as long as there's no in-family fighting, they can control and sway decisions of things that happen. So it's pretty interesting.
no, no, the point is, the point's well taken. When I was at Public Storage, the Hughes family, even though the company was public, they retained, during the time when I was there, north of 30% of the voting power and shares in the company, and that was enough of a position that they could exert very, very significant influence, and it also put them in a very better position than some of their counterparts at other large self-storage industries that didn't have that kind of control or influence over the shareholder base. So that level of structuring and thoughtfulness and how you organize that cap table, that's even after you're a public company, is invaluable.
And I think about where this comes in handy too is when you're negotiating, right? Like, when you're trying to maybe do a large contract or you're trying to get financing or you're looking to create some, mid-tier liquidity event or distributions. And, how many votes do you hold versus, the rest of the board or the rest of the decision makers or the rest of the investors? I think it's important, if you want things to run properly, is to maintain advocacy among the shareholders and among the board members. I mean, I'm sure you've seen when that doesn't happen, what can go wrong.
Oh, no, very much so. I mean, oftentimes these type of secondary transactions, they're not straightforward. They require investor approval. And there is questions about the signal that you're sending to the marketplace. Anytime owners sell shares, it makes people consider whether the company has reached a plateau, and whether they should either do the same or hesitate to invest. It's why people carefully track corporate 13D filings. When insiders buy or sell shares in a company. These things are they're very closely looked at, and uh, you know companies with complicated cap tables, and some of them have very restrictive transfer provisions or heavily negotiated investor rights, can have find it difficult to execute one of those type transactions because they'll just get blocked.
Right. It's interesting, I was thinking about you know, just founders in general and and you see a lot of this too when we do have rounds of capital that get raised and you mentioned $10 million, $20 million, $30 million, depending on the progression of raises and how it goes. Is that I notice and I've experienced this myself where you have a founder or somebody that's a majority shareholder that hasn't managed that level of capital before. and the wrong decisions a lot of times come out of that. So, um, what do you say to founders when you see this pathway happening and saying, well, I know you, Joe, founder, and you know, I know for a fact you haven't managed this level of capital before. So how do you approach that conversation? Then I'll tell you how I approach it.
Well, the way I approach it is I usually introduce them to people like, yourself or private wealth managers who can assist them, in terms of their personal long-term, financial planning, as well as, help them, perhaps, create a mechanized plan for them to, just systematically, put a plan in place that, sells off, X or Y, number of shares based on certain events or, the stock reaching certain prices that can, uh, cause or that can allay investor concerns that the company's plateaued, or that the insiders are operating on, some kind of inside information. But it's never too soon, and I like to refer people to clients on the legal side, to firms like Regiment to help them to manage those type of changes in circumstance in their lives. It's just like an athlete, who someone who's a great star in college becomes a pro athlete, and all of a sudden is making millions of dollars. They don't know how to invest that wealth, and sometimes they can burn through it very quickly if they're not well advised.
It's interesting you use that example, not to go down a rabbit hole, but what we're seeing more and more is because of the NCAA and how much these athletes are getting paid out of high school. We're now finding that we have to help the athletes as well as the school restructure their financial model and ownership and cap tables and all those things. I mean, we've had to help bail out some athletes that just got into the wrong financial plan or the wrong financial situation. Like you said, just like we talked about a founder, they're receiving, $10 million for their contract. And before you know it, it's all misused and misspent. And, they're trying to take care of their parents and their friends and things like that. And they don't think about themselves first. We always say, on an airplane, put the oxygen mask on yourself first. So even though it's nice to get this money, you have to look out for you so you can take care of your family and manage your money so that you can let it last during your career and beyond, right? But that goes for founders and businesses too, right?
Exactly, and as with businesses, with athletes, those decisions need to be made earlier and earlier. I mean, it used to be wasn't until someone turned pro, that they got the big paycheck. Now they're getting NIL deals, while they're still in college, to your point, and so you've got 18-year-olds, needing to, manage, these kind of incomes. And in many respects, founders and businesses, their expertise is in the business. They had a
Right.
brilliant idea, they created a startup, found a niche, in a particular market. And they're not used to thinking about these things, and they're novices when it comes to managing the money.
Right. Yeah, that's interesting. I also, going back to the board for a minute because this seems to come up all the time. I mean, I'll be asked to, if I'm raising capital for a company, sit on the advisory board, and it's nice because we can keep a close watch on things. And again, when that funding is hitting the door, make sure the right things happen and guide them. And what's from your perspective, is there a revenue strike point or a business size strike point, which is typically gauged by revenue, where you determine that, hey, listen, it's time to get some other conversations or heads in the game here, and maybe you need a advisory board, and then you go to an executive board at some point. Are there phases of a business where you see that more appropriate depending on the size or the amount of revenue that's generated, or how do you look at that?
Well, I sit on a couple of advisory boards. One's on a company in the, cybersecurity, business, and I don't think it's ever too early. I mean, I've been on an advisory board for that since, almost since its inception. Um, and I think, it's just a part of, prudent planning. And um, I don't think there is a point that's too soon for that.
Yeah, I agree. And I think too, I always think of um, I always fear the speed of business, because a lot of times a business gets cash and they spend it on the right things and the business takes off. And that's when everybody forgets about everything you and I are talking about right now. And they work on the business and they're spending all the money and things are going gangbusters and it's a hockey stick scenario, but they're not putting the right governance in play, or they're not putting the right things in play to make sure that the wheels don't come off at some point. It's great to go fast, but if you have the wrong tires on a car, going fast is bad. The tires can blow out.
I, I, you're absolutely right. I always try to keep in mind, sort of one guiding core principle as you navigate through all of these corporate life cycle events. You're well served to do the best you can to preserve optionality. And that means as a company matures, retains the ability to pursue different strategic paths, whether that involves, remaining independent, pursuing a strategic acquisition, completing a recap, or, eventually, entering public markets. It's, these are things that all dictate, for a clean and an understandable capitalization structure, one that takes into consideration some of the topics that we've been talking about today and the areas, where things can go wrong. And um, and it, it keeps from surrendering leverage and negotiating power.
Yeah, for sure. It's interesting. I want to go back to, you had mentioned secondary liquidity. And it's always interesting because, when we say that and then people think about it, is there a time in the life cycle of the founder or a life cycle of the business where liquidity makes sense? And from your lens, is there a time where it makes sense for them to think about, well, maybe it's time to give up or some shares, or it's time to have an event here?
From a psychological standpoint, um, uh, a little bit of modest liquidity can make founders much more patient and focused on long-term value creation. And from that standpoint, it's not wrong or an imprudent idea, if you are looking as, like a VC in a 8 to 10 year life cycle, at some point midway through, perhaps, to allow the liquidity, a, a a minor liquidity event and take some pressure off the owner, keep them focused on the long term building of the company. I don't think somewhere in the midpoint of that life cycle is imprudent. I don't, do you see it sooner than that, or is
Yeah,
that too soon?
sometimes yeah, sometimes I do when I get that sense. And again, we do a lot of background checks and his run history on people and things like that. So we get a flavor for what we believe the founder is capable of for their own protection and the company's protection, right? So we tend to really look at that profile, and like you mentioned, the psychology of the founder, right? And when we see missteps or patterns start to, start to come down the line, or the way funds are utilized within the company, that's when we sort of throw up the red flags. But a lot of times we know that's going to happen because we know they've never had $5 million per year before, or $5 million in the bank before, $10 million in the bank before. And now we want to protect them for their own sake, and that's a hard conversation sometimes to have. But what we try to do is we try to do it before we do the cap raise, before we do, the event. I have the one business that I mentioned, that, we had raised 80 million, and there was a lot of turmoil that happened after that capital was raised, and a lot of restructuring that had to happen, and then it sort of leveled off a little bit, and now there's a potential round of 200 million coming in. But I was very strict after watching what happened with the first cap raise, or the first couple cap raises, to say, listen, if this money is coming in, I'm sorry, it can't, I'm responsible for that capital. I can't, with good conscience, allow that capital to come into the company while you're the CEO. So I had to have a very hard conversation. And it was interesting because it was actually what, better received. And we had had previous dialogues leading up to that when we had the previous bumps in the road. But what we want to do is try to catch that before there's bumps in the road.
Oh, absolutely. It's always, better to undertake any significant corporate event under a clear blue sky and not when the wolf is at the door, or there, major, some significant drama going on, in an industry. And, that's why, having the staged approach to liquidity, can not only keep the owner focused, but it can help them to reduce their personal, wealth concentration and risk. So I think, for all those reasons, as well as the desire not to do it, when, there's a storm, that's landing, or about to land.
Yeah.
It's better to put these plans in place ahead of time and, to thought them through. Uh,
Yeah, and always be ready for a storm, right? So always believe something's going to happen in the market, something's going to happen with employees, something's going to happen to you. Always be ready for that storm. So many times a lot of us are not ready for that storm. And I always think about, maybe what I always like is an annual review. So we look at the business, we look at the previous year, we look at the projections for the next year, like to meet with the board, get their feedback and input, and then engineer potentially multiple paths for liquidity or exit, or the next round of capital, whatever that looks like. So mapping out a potential for a strategic sale or a merger or recapitalization or maybe even an IPO, and make sure that we have the right momentum, the right players, the right capital support to make that happen. So I'm sure you see a lot of that because we come to you to draw up the agreements. We get everybody to agree. Now it's like, okay, let's put it on paper. This is our new operating standard, right?
Well, it's always important to to paper whatever the path forward is, and to have good people who are advising you both on what the overall objective is, and then to have other advisors like the lawyers come in and execute the plan, and make sure that the I's are dotted and the T's are crossed, and that ultimately the plan that has been agreed to at the board level is the one that ends up getting put in place, and isn't as it's buffered against those kind of disruptions as you can reasonably plan.
Yeah, for sure. Well, Jack, it's that time of the program where we want to hear from our audience, and we have some questions in the queue. So I think we start to pick those off. So Verletta has a question. I put an exit strategy in my business plan. Well, maybe it's more of a statement. Just getting started this year. Do we have any advice for Verletta? So, and I think exit planning is key. So hopefully you have, and again, in order to do an exit plan, you have to do a valuation, and you have to obviously have all those mechanisms in place. So Jack, does Cogent get involved in the exit strategy, and at what point?
Well, very much so. The point at which we get involved, we certainly prefer to be involved early in the planning stages, and when we can still have significant influence before any bad documents might be put in place that limit optionality as things progress. But we're oftentimes called in at the last minute, when things have built up ahead of steam, and things need to be turned around rather quickly. We work in both environments, but frankly, we can be a better asset, from the legal perspective, and assist even more in the earlier stages before other things are set in stone or things have been agreed to that are disadvantageous, to the company or the founders.
Yeah, that's excellent. And I think it's and always make sure that you talk to your attorney, your accountant, and make sure when you're dealing with exit strategy, because it can come from a lot of different camps. It could be financial advisors driving this, and I was in the Exit Planning Institute for quite some time, EPI, which has a lot of good advisors that are trained in exit planning and exit strategies. But again, experience matters, right? So just make sure you look at the track record and experience of the people that you're working with, and then ask your current advisors to make sure it's not just you vetting those people, but that they take a look at those folks as well. Um, and we tell people, even they're doing business with us, make sure you check our references, make sure you check the people that are part of your company that you rely on to make the decisions. If there's a board, we love being in board review, so, and I'm sure you do too, Jack. So, that's important to get everybody's weigh in on those things. Um, the next one is laborious, and I think this is more on that looks like more on the real estate side, but what type of deals are you actively looking for? Well, I think both Jack and I are blessed that we don't have to look for deals. But what are we seeing in the market? Like what's moving the best? And from our lens, our real estate side, we have a couple of different departments. So we still see multifamily on the move, although I think it's going to hit a bubble soon. And then we see a lot of BTR, which is build to rent communities. But the biggest thing coming up is a lot of people don't know about this. There's a housing shortage, which most of you should know about, but there's also a lot of failed master plan communities out there. Jack, you could have an entire business division just helping out failed master plan communities as they restructure because they haven't planned to be a failure, right? And so we work with a lot of capital that goes out to save and recover those communities. So I think, you don't hear as much about that, but that includes everything from hospitality to mixed use to data centers, things like that, that actually go in those communities. It could be churches, schools, all the above. So that's where it's significant. It's significant to just pay attention to what's going on in the market and just keep all that in mind. With Ernest, I think he was on last week. He's our Shark Tank winner after winning a pitch. So congratulations again on that. Um, so out of 200 people, so congratulations. So I guess they said that he would be a 10 plus figure business. So congratulations. There's a lot to do before you get there, but congratulations. How do we confirm liquidity, shares, stocks, participation rights, or stack preferences, or anything related to larger partners like this, investor partners like this, so we're not possibly taken advantage of or later down the road? Or do we wait until it grows significantly? No, I would say, like we talked about earlier, and then Jack, I'll listen for you as well. You need to plan this now. If that is a conversation that's being had right now or a thought, think about it today while you're growing. Think about it today before the larger investors. Make sure you're protected on the cap table and just go through the exercise of pretending that investors are coming in and now what happens to you? How do you get diluted? How do you get protected? And make sure you look at all those things and have Jack or somebody at Cogent make sure they look at all the documents. So, Jack, I'll let you chime in on that one too.
I would just concur. The short answer is no, do not wait. The earlier, the better, because no large investor is going to be looking after you or looking out for, for you or your interests. They're going to be looking out for their own. The really the only person and the only time to protect your own interests is as early as possible, with the right, advisors, both on the financial side as well as the legal side to try to avoid, exactly the types of things that could limit your optionality, and surrender negotiating power and leverage. You're never going to have more leverage than you do early on. That does not grow over time. It tends to get whittled away as investors come in.
Yeah, that's an excellent point. So hopefully that helps, uh, and we'll send you a copy of this recording as well. So moving on. So somebody asked, about a business disaster recovery run book, which is interesting because I have a whole technology background. I've always owned tech companies of some capacity. Um, and so, and what you're trying to do is prevent disruption, operating disruption in the business. Remember when we talked about things can happen in a company that we don't plan for? Well, this is something you definitely want to plan for. So who should be involved in this? Well, anybody that's executive leadership, right? The CEO, the COO, the CRO, or any unit business leaders that could be affected by this and how the business is ran. You definitely want to have IT and technology leadership. I mean, your CIO, CTO, or if you outsource this, they have to be part of the conversation. And please, consider cybersecurity and there's insurance policies. This is like a whole webcast in itself, so I'm not going to go too deep into this. Operation, business, and unit leaders. And then the most important is with us today. Besides your finance, you want to have legal and compliance involved with these policies and processes. So, Jack, how does Cogent get involved in something like this?
Well, oftentimes, we're asked to either review or help to formulate a plan, and from a contracting standpoint, there are always force majeure and other, clauses that can be shaped and structured in a way to try to minimize your exposure, in the event, of a business disaster recovery, but as Dean indicated, having the right people on the technology side and having the right insurance coverage is very important, and critical, to be able to recover as quickly as possible. We help on the legal shaping of a disaster recovery plan, but that's a really multi-advisor, multi-talented team, that ultimately needs to sign off on that.
Yeah, excellent. Thanks, Jerica, for that question. Forrest has a question. Founders often regret banker-driven terms that harm them later. How should founders override bankers with solid legal advice on equity vesting and exits? Um, I always say that, you want to have co-accountability, right? So, and bankers, a lot of times traditional commercial bankers, you have traditional commercial bankers, then you have us that are investment bankers, and then you even have fintech level bankers. So that's a whole another category. But I would think, based on what you're talking about with financing terms, bank accounts, how your money moves, that you should also make sure you get your accountant involved with that and even legal to make sure that what you're signing up for or what you're agreeing to is in alignment with the thesis of the company and the way it's structured and the direction of where you're going. So, just like we were talking about the disaster recovery, we should definitely have consideration for this component too, is every time you make a banking or financial decision, you would want to get all those parties engaged. Jack, any other thoughts to adding to that?
I would just add that on the internal team, it's crucial to have a very strong CFO. And most well-run companies, the CFO and, the chief legal officer, and their respective outside advisors, that's a critical partnership in terms of evaluating, any terms that are being proposed, by a banker. You need to analyze it from the financial side, the accounting side, as well as the legal side, prior to the sign off and prior to putting them in place. That's really your best defense against, um, you know, uh, onerous terms. At least that way you understand, and perhaps you don't have the leverage to avoid some of the onerous terms, but you understand what you're getting into. You understand what you're signing and how it may limit you later. And you've done your best to negotiate the terms, to something as close to market as possible.
Yeah, absolutely. All right. Well, I think that's our questions for today. And like always, we want to thank each and every one of you that participated in today's program. We'll make sure that you get a copy of the recording and the slides, and do appreciate the questions that you're asking and the level of engagement. So Jack and I truly appreciate that. And I think, as have parting words, liquidity isn't something you arrive at. It's something you design or plan for, like what we've said. So make sure, you start now, wherever you're at in your journey. If you haven't thought about this, plan for liquidity, plan for the disaster recovery, and take the time out to do those things as desired. Jack, any parting words for the guests here?
No, simply that that we would encourage you to feel free to get in touch with us. If your situation is one that we might be able to assist on, we're usually willing to schedule a 30-minute call, to have a conversation and and advise what Cogent or one of our professionals might be able to assist you with. And just mentioned that we were remote long before the pandemic, and we tried to pass that cost savings along to clients, and at some attractive rates. So, but we're happy to have a complimentary free 30-minute consultation prior to an engagement.
Yeah, for sure. And again, make sure you stop and listen before you make any of these critical moves, just like we talked about today. So can't emphasize that enough. So we wish each and every one of you very much success in the growth of your company, and do encourage you to reach out if you need help. And don't be afraid to ask. It's like nobody expects you to have all the answers, and don't be afraid to ask. So, from all of us here at Cogent and Regiment Securities, we want to wish you the best of luck with your business. And then again, like Jack said, if you need us for anything, please give us a call or shoot us an email. Thank you again, and we'll see you guys very soon somewhere down the road. Take care, everybody.
Thank you again.